Of course, as Jared mentioned, the big news today, another announcement from the Federal Reserve. In this world, it seems like a long time if we haven't had an unprecedented Fed action in 3 weeks. But that's how long it had been since we'd last heard from the Fed. Brian Chung joins us now for more. And Brian, let's start with what the Fed announced this morning, and then maybe we can get into some of the comments we heard from Jay Powell later in the morning.
Well, first they threw the sink and then they fired off their bazookas, and now whatever you want to call it, but it's $2.3 trillion that they announced this morning before the market bell. This will cover a number of new, again, unprecedented types of liquidity. It's trying to backstop, first of all, the municipal debt market through a separate facility that'll buy short-term debt from states and cities and even some counties for up to 24 months in duration. It'll also target Main Street business lending through their Main Street business lending facility, which they had previously announced. We're finally getting more details on that. $600 billion, which would be was supported by some money from the U.S. Treasury that was appropriated in the CARES Act passed a few months ago. And then another big bit of news expanding the existing primary and secondary corporate credit facilities to take on some high yield debt. But all of these things came just before Jay Powell was set to speak in a webinar with the Brookings Institution, where he said the Federal Reserve is going to do what it can to try to help support the economy. Here's what he had to say this morning.
Many of the programs that we're undertaking to support the flow of credit rely on emergency lending powers. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery.
So Chairman Powell really trying to illustrate that using these three adjectives, wanting to message to the American public that really the Federal Reserve still has a number of bazookas left, if you want to call it that. Keep in mind, the Federal Reserve used $195 billion of the $454 billion that were appropriated by Congress in its actions today, meaning it still has over half of that money to use for other liquidity facilities, meaning we should watch the Fed to see if it does anything else if market conditions or liquidity ends up becoming a problem elsewhere. Miles?
Yeah, and Brian, I think at this point, it's well established that the Powell Fed is certainly being more proactive and I think a lot more creative than we've seen Feds be in the past. And I think that Ben Bernanke got a lot of credit for what happened in 2008. But with the benefit of hindsight now, I think there was maybe a lack of creativity out of that Federal Reserve. And I think it goes to something Powell brought up today, which is the explicit and clear coordination that they have with Treasury, because Treasury is a group of elected officials, right? That's an administration that people voted for and they want certain policies. And I think it's interesting this morning to hear Powell talk about what he thinks is the duty of the Fed, not to just act unilaterally and act independently, but act in concert with people who are accountable to voters. It's a very different conception, I think, of the Fed than maybe the academic one that was held, just 10 or 20 years ago.
Absolutely. And what's not only unprecedented about the nature of these facilities, because again, as you mentioned, these types of things we've never seen before. We've never seen the Fed go directly into, fallen angel level of debt to try to prop up and make sure that there aren't a wave of defaults. So we haven't seen them go directly and buy muni bonds through these types of facilities before. But when you mentioned the coordination between the Fed and the Treasury, you actually had Jay Powell using his remarks this morning to pretty explicitly lay out that that's not a preference. That's not necessarily a nice to do kind of gesture that the Federal Reserve does. That's statutorily required. So the Federal Reserve does have emergency lending powers under Section 13.3 of the Federal Reserve Act, but it can't just go out and directly buy things. So we have to understand that the Federal Reserve does require the approval of Treasury when opening up these types of liquidity facilities. And we could argue to what degree semantically you even want to characterize some of the actions today as the Fed going out there and providing $2.3 trillion of loans to the economy as quantitative easing or trying to expand its balance sheet. It's separate. The Fed's not buying a lot of the direct things that it announced today. These are actually being purchased through a special purpose vehicle that's being funded and provided with equity or credit protection from the U.S. Treasury. It's not technically the Fed adding munis or adding ETFs that are high yield onto its balance sheet. And I think that's an important distinction for a lot of people that are watching this.
And, as someone who wants the state to expand its fiscal capacity, I love to see it. You love to see the Fed saying there is no limit to the money that can be spent. But Jay Powell essentially saying to Mnuchin, and Mnuchin gets the message, maybe all lawmakers don't, that they have to say how much the Fed can do, and then the Fed goes and does it. And that is exactly what's happening here. All right, Brian Chung, thanks for that. We'll talk to you later.